Good morning everyone, this is Sakis Paraskevo, fundamental analyst at IronFX Global, bringing you the morning comment for the 3rd of February. The Reserve Bank of Australia joined its global counterparts in easing policy. It cut its benchmark interest rate by 25 basis points in an attempt to stave off deflationary pressures on the back of low oil prices. In the statement following the decision, Governor Glenn Stevens said that the output growth will probably remain below average for somewhat longer, and the rate of unemployment could peak a little higher than earlier expected. The economy is likely to be operating with a degree of spare capacity for some time yet. Therefore, a reduction in the interest rate was appropriate to boost growth and prices. The central bank remained concerned about the housing market, and in the statement it said that the bank is working with other regulators to assess and contain economic risks that may arise from the housing market. The bank will most likely increase the macroprudential tools to offset the level of house loans and take the hit out of the housing market. Hence, with interest rates now at record lows, the impact on housing prices will be watched closely. Aussie USD dropped sharply on the announcement of the rate cut to its lowest level since May 2009. The fall was halted around the 0.7650 support line, but given the absence of price pressures in the economy, the low oil and commodity prices, and the possibility of another rate cut at the future meeting, the pair is likely to remain under selling pressure, and we could see further declines at least until the 0.75 level in the near future. Elsewhere, oil prices rose after news that drillers put 94 rigs from the US fields last week, and a refinery strike, the biggest since 1980, could tighten gasoline supply. US benchmark WTI gained approximately 10% since Friday's news on the drop of oil rigs to a 3-year low, while Brent rose 6%. We believe that nothing has changed fundamentally, and there are no signs of sustainable reduced global output. As a result, the recent rise in oil prices could be seen as a bear market correction. As for today's highlights, during the European Day, the only noteworthy indicator we get is the UK construction PMI for January. In the US, factory orders for December are expected to fall at an accelerating pace. In New Zealand, the Q4 unemployment rate is forecast to decline somewhat, while the participation rate is expected to increase. Last week, the Reserve Bank of New Zealand remained on hold but went from a tightening bias to a neutral bias, and even held out the possibility that the next move in rates would be a cut. This, together with the decline of the inflation rate below the lower boundary of the bank's range target, kept Kiwi under increased selling pressure. The positive labour market data, however, and the fact that the pair is trading near a strong support level could push New Zealand dollar USD up before the bears prevail again. As for the speakers, St. Louis Fed President James Bullard and Minneapolis Fed President Narayana Kocherlakota speak during the day. For more information, including technical analysis, please read the full comment on IronFX.com. And also, follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevo, fundamental analyst at IronFX Global, wishing you solid trading.